So we're going to talk about the firm's supply curve. Now, a perfectly competitive firm's supply curve shows how the firm's profit maximizing output varies as the market price varies. Other things being the same, of course. Because the firm produces the output at which marginal cost equals marginal revenue, and because marginal revenue equals price, the firm's supply curve is ultimately linked to the marginal cost curve. So a price below the shutdown point, the, the firm will pretty much produce nothing. And I forgot to mention that in the last video, the shutdown point will be this point here where marginal revenue equals marginal cost. So let's take a look at these graphs that I have here. Now, this graph will show us how a supply curve is constructed. So if the price is equal to the minimum average variable cost, which is $17, then the firm is pretty much indifferent between producing nothing and producing something at the shutdown point T. So this is pretty much the lowest point we can go. We can pretty much get, if we can get or sell our shoes at $17 per pair, then that is where the marginal revenue equals the marginal cost, and that is our shutdown point. And I made that clear in the last video, just restating it again. So what happens when the price is equal to $25? So when our price is equal to $25, like I have here, then we make nine shoes per day. If the price is equal to $31, then what we'll do is we'll make 10 shoes per day. So essentially what we found out is that at $17, that will be the price at which our average variable cost is covered. Well, all our average variable costs are covered. So if we can get more than that, if we can get more than $17, then of course we will make more, because in that case we will cover our average variable costs in addition to covering some of our fixed costs. So the total fixed cost that we will eventually get, the amount that we will lose is less than it would be than if we just shut down the whole operation and just paid the total fixed cost. So with that, let's just draw our curve. It might not even be a curve because I made this drawing so horrible. So, oh no, fuck. I thought I had the curve, but no, I didn't. So we'll just move the dot. And there's our beautiful curve. So this blue curve that I'm tracing shows the firm's short-run supply curve. So between the prices of 0 and 17, we pretty much shut down. At the point at price of 17, we are indifferent between producing or not producing. Any price above that, then we are producing, because we can cover our average variable costs and some of our fixed costs. And it's as simple as that. Hope I made it clear. In the next video, we'll talk about market supply in the short run. But for now, I'm just going to end this video here. Please rate, comment, subscribe if you haven't already, and I'll see you guys in the